Hello. Tonight we're going to talk about budgeting. And one of the key things I'd like to focus in on right up front is the concept that when we speak of budgeting, we're always talking about the future. I think there's a common misconception a lot of times the financial statements are referred to as budgets when in fact they are actual results. And we just distinguish actual results from budgeted results. So keep that in the back of your mind as we're going through this. As this slide indicates, budgets help us in the planning and control process, and they help us in each of the ways that's indicated on this page. We're going to talk about each of them very briefly. Beginning with strategic planning. Uh, Organizations should have mission statements. The mission statement essentially describes what the organization is and what it plans to do. I happened to look up the mission statement of the Cleveland Clinic. You probably all know it. It is to provide better care of the sick, investigation into their problems, and further education of those who serve. The strategic planning, the mission of an organization is carried out by establishing goals that are then met or hopefully met in order to accomplish the strategy itself. Again, the Cleveland Clinic has a number of objectives that they list: excel in specialized medical care, develop and share new technology, attract qualified staff, be excellent in service, provide access to affordable care, and ensure the quality underlies every decision. These objectives are, again, stated, the general public can see them, and it describes what it is that the clinic is going to do to carry out their mission. The mission, the goals, the objectives, and the organization strategy all flow from the vision that the organization has. The Cleveland Clinic's vision is to be the world's leader in patient experience, clinical outcomes, research, and education. And it is this vision that they attempt to accomplish by following their mission and their strategy and by setting objectives that allow them to achieve that end. Budgeting helps us in the planning process because it requires us to commit to paper uh, what we're going to be doing in the not only near term, but also in the longer term. And by establishing plans, it allows us then to measure our performance against what we thought we would do. Once budgets have been prepared, they can be used to help guide what actions are taken in order to accomplish the objectives that are contained in the budget. And the final element here is the controlling activities. The controlling activities can be accomplished because, as I said earlier, the budget gives us a basis on which to compare actual results against intended results. We'll have a little bit more to say about that in a few minutes. Okay, I copied this slide from obviously your textbook. This is in there. It actually reveals a lot of information. And it also points out that in some respects, the definition of a budget is very much like the definition of a cost. I say that because just as cost can be put into different buckets, if you will, depending on the specific cost object that we're talking about. A cost can be direct with respect to one cost object and indirect with respect to another one. So can budgets be discussed along various dimensions, as the slide says, in different ways, and the same budget can fall into some or all of these categories in a different place. I want to spend a little bit of time talking about each one of them, starting with the first one. Why not? Participation. What we see here is the range of activity between one that's fully authoritarian and one that's participatory. What you can view here is on the left, it's a top-down situation, and on the bottom, on the right, it's a bottom-up situation. Authoritarian budgets are ones where management dictates what the various budget items is going to be. And participatory is where the people that are responsible are the ones who determine what the budget is going to be. More often than not, the participation level falls somewhere in between. The authoritarian wants to exercise some control, but requires the participation of the people on the ground, if you will, because they know best what the obtainable goals are for that particular department. We look at the second line, the model of the budget. You'll see on one end the incremental decremental, and on the other end the zero-based. What we're talking about here is how the budget is put together. Very common situation to use the left-hand side incremental decremental, in that you oftentimes will start with last year's budget and then make increases or decreases to individual line items in the budget based on your analysis or expectation of what's coming in the future. Under a zero-based budgeting scenario, annually, in the most radical case scenario, annually the budgets are reset to zero, and every single line item needs to be recreated for the next year with explanation as to why that particular line item is needed in any particular situation. Zero-based budgeting is not used in too many situations because it's very costly, because it's very time-consuming. The incremental decremental approach is a much easier approach to budgeting. Here again, oftentimes you will find the equilibrium point somewhere in the middle of those two extremes. With regard to the detail, this is kind of an important line down here. You see everything stretching from line item through program to performance. And these are different ways that we can view the individual budgets. The line item budget is the one that contains probably the least amount of information, in that it tends to be very focused in a particular area. It will deal with performance, actual versus budgeted results for individual line items, individual expenses that might be incurred within a particular area. The program budget expands that a little bit to show how various programs within the organization are performing. And the performance budget adds frequently non-financial measures in order to further indicate the success of meeting the goals of the organization. As far as the forecast period, the two lines here, the budget can be annual, can be multi-year. Many budgets are prepared on what they call a rolling basis, where we might do a budget for a month and have a time frame, a window of, let's say, 12 months. And every time a month passes, we drop off the month that has passed and we add a month on to the other end. So we always have a one-year picture of the budget going forward. Budgets can also cover multiple years, and in U.S. organizations, more often than not, that's a 4 or 5 year window. Those budgets tend to be prepared with less detail than what you would find in an annual budget, because they are more like roadmaps to where you want to go in the future, and as I say, they don't contain a lot of detail. In fact, I heard a report several years ago that some of the leading Japanese companies, Japanese firms being ones that implemented new management techniques, in many cases in advance of the United States firms implementing those techniques, that some Japanese companies such as Toyota or Honda or Sony might actually budget for a period of 500 years going forward. Now, when you budget out for 500 years, you clearly don't have a whole lot of detail in that kind of situation. But the fact is, when you budget out for that number of years, what you're really saying is that we have a vision of where we want to go. And while nobody would be around to know if you succeeded in that vision, it is a technique that allows you to be forward-thinking and to consider what might change in the future going forward, because lots of things do change. The next line down here, the dimension between static and flexible. A static budget is one which is prepared at a single expected operating activity level. So for instance, if you're going to prepare a cost budget, one of the things you would want to know is how many tests you expected to run during a particular period of time. And because some of your costs are variable, that is, they change with the number of tests you run, the amount that you budget in a static budget would only show what your cost would be at that particular level of activity. Flexible budget, on the other end, would allow for changes in that activity level and would consequently result in different budgets being prepared at different activity levels. And in fact, what is often done is after the fact, maybe you budget for, I don't know, 100 tests a month. You could also budget for 110 and 120. And you would have a flexible budget in that you would have different amounts for each of those different activity levels. But if your actual activity level was 112, you could, after the fact, create a budget that would establish what the cost should be at that level of activity and then use that for comparison purposes. The last dimension that's listed down here is the modifications. The question is, can you change the budget after you're in it? At one extreme, you don't if it's controlled, and on the other extreme, you do have the latitude to make modifications when required. This next slide discusses the different types of budgets you might run into in your organization. The ones I want to focus on, actually the big one is the operating budget, the second one that's listed down there. And we'll talk a little bit about the capital budget. We've actually already discussed in a prior period the cash budget. And a statistics budget is really just a budget that will help you determine the activity level that you're going to be working at. So when you translate that into dollar terms, it will flow into the operating budget, the cash budget, and the capital budget. Budgets, of course, are quantitative. And the real reason for that is that numbers happen to be the best thing we have that we can use to measure the performance of the people and the organization itself in comparison to what the plans are. As it says, both financial and non-financial data can be included in a budget, and sometimes it's the non-financial data that may be construed as being even more important. More important in the sense that it is what drives the dollar figures that are presented on a financial budget. You can certainly have goals and objectives that are set in terms of levels of performance that do not have anything to do with dollars. But as you'll see a little bit later on, not tonight, that variance that's caused by the difference in performance between what's on the budget and what's actually incurred can be divided into two components, one of which is driven by the volume, the activity level, and the other which is driven by the dollar amount of the activity itself, the cost. This slide clarifies for you what the advantages of budgeting are. The first bullet there, in terms of judging performance, again, I think of it as the way we talked about a cost, different definitions. If performance can be measured at many different levels, starting with the individual and going all the way up to the entire organization itself. Throughout all those subunits, there can be all kinds of budgets produced that have to be coordinated for the best operation of the organization to occur. Budgets are intended to be used to motivate people to do their job the best they can and to try to get better in their job if they can. It's okay to ask managers to do better or do more, and you can give them goals that are a stretch that cause them to work harder in order to obtain them. But you have to have some level of reasonableness in the goals. They have to be certainly obtainable at some level. And you also have to be very careful of the behavioral effect of asking somebody to do something that is virtually impossible to do. Because, of course, as human beings, if we're faced with a task that we cannot accomplish, if we don't feel there's any way of doing it, our performance is going to drop off in general just because there won't be any motivation to do the work. This is an issue with budgets. You have to be very careful about not using them as a hammer to beat people over the head with. You have to work with the employees and make sure that everybody understands that the purpose of the budgeting is to get the organization to be functioning in the optimum manner that it can. By holding people and divisions responsible for performance, you can encourage the whole organization to work toward the common goal as stated in their strategic plan. The master budget is made up of individual budgets of different sections of the organization that, taken together, can create a picture of what the entire organization, or how the entire organization will perform in the coming, let's say, year. The operating budget would be the budgets of the various revenues and expenses that the organization has. The financial budgets use the operating budget to figure out what the asset and liability balances are going to be at the end of the year by projecting purchases of assets, by projecting how much collections are going to come in cash and get payments in cash, how much billing is going to go out, and how much collection on that billing is going to take place, can all lead to a projection of what the annual financial statements would look like. All right, these are how you go about preparing an operating budget. Now, individual managers may or may not be responsible for all of these items in a particular budget. Depends on how much authority and responsibility they're given in the organization. In the divisions that you're in, I would not expect there would be any revenue budgeting that takes place, but certainly the organization budgets revenues. You may have some revenue budgeting that takes place if, and I don't know if this happens, you may end up taking something from your department and transferring it to another department. We talked about tissue or sample coming in from another place. It could be that those items are costed in the department that they came from, and when they come to you, they carry a cost that you then add cost to and is transferred up the line perhaps to another organization, another division within the organization. In some of these cases, there will actually be a revenue assignment to those transfers. It's just an assignment, it's a bookkeeping number, but it's meant to improve the decision-making activities of the individual divisions if there's an opportunity for competition. Put another way, let's say that there's another lab in a private lab that will do the service that your lab provides. And you know that if you had to have a test done that you didn't have the capacity to do in your lab, you could send it to that lab. Well, that lab would generate a cost. I mean, it would, but that would be revenue for that lab. And so your organization might view that as being the value of the output that your division or your laboratory, let's say, produces. Otherwise, I don't think you're going to see too much revenue budgeting. Cost budgeting is probably a little more common. The materials, the labor, the overhead, and the operating expenses are all budgeted as part of the operating budget. And so what you can see we end up with is a complete picture of what the income is going to be, because we're budgeting our revenues and our expenses. The financial budget results in the creation of the budgeted balance sheet and the budgeted statement of cash flows. The operating budgets feed into both the capital budget and the cash budget. Capital expenditures budget is your budget for purchases of equipment. It could be buildings, land, any fixed asset, long-term, long-lived asset. Are budgeted in what's called the capital budget because those expenditures are very large typically. They are investments that are expected to assist the organization for a longer period of time than just say a one-year window, the typical operating cycle. They are, of course, subject to depreciation, and they oftentimes, the capital expenditures budget will be derived through a present value analysis, since the cash flows that are associated with it may stretch out over a period of time as well. So the capital expenditures budget allows us to determine what our fixed asset levels are going to be at the end of the year. and other investments that we're making. The cash budget, we talked about, of course, earlier in the course. The cash budget helps us project how much cash we're going to have, and the cash amount we have is a very important number because cash is the grease. So budgets, we're going to talk about variances even more in the next chapter, so I don't want to say too much about that here, but it's pretty obvious that one of the major purposes of budgets is to allow you to do this analysis of comparing actual and projected amounts. From a management perspective, it allows us to practice what we call management by exception, which is you want to look at the places where there are variances, where there's differences from projection. It may be that the process is out of whack and controls need to be implemented there, but it also may be that the projection is out of whack. And so it could be either of those types of things that cause plans to go off kilter. Okay, finally tonight, this slide on the human behavioral aspects of budgeting. Budgeting creates an interesting situation where the person being managed has information that the manager may not have, because the person being managed is the one who's doing the job, and they have more of a sense of what the job takes. No. So the person being supervised, the subordinate, as it says here, actually has an incentive to build this budgetary slack into the budget, to produce budgets that will not require them to work at their optimum level. The manager, of course, knows that the subordinate has the better knowledge, and also knows that they have the ability, therefore, to create this budgetary slack in the budget. So again, it gets to a motivation issue. At what level do you set the budget to accomplish the goals of the organization and require or instill in the employee the idea that budgetary slack is not going to help the organization in any really good form. This is also an example of a moral hazard, a circumstance where one person has an incentive to end up getting the better end of the deal, that being the subordinate in this case. The moral hazard scenario can be somewhat reduced by making sure that both of the parties that are involved here have a stake in the game, if you will. Making sure that the manager gives the subordinate a higher level of achievement to accomplish, and understanding that the achievement will only be done if it's reasonable and has been discussed ahead of time with the subordinate. All right, I think that does it for tonight. I'll see you next week.